Good day, students of economics. The purpose of this video is to investigate the causes of the 2007/2008 financial crisis, which led to one of the worst economic downturns in U.S. economic history, and to examine the response from both our federal government and our central bank, the Federal Reserve. Prior to examining the particulars which caused the 2007 financial crisis, it's important to examine the traditional mortgage lending rules which existed in the United States post-World War II until the government changed these regulations. Altering these regulations was one of the causes of the 2007 financial crisis. Great Depression plagued the U.S. economy in the 30s. World War II, United States emerges victorious from the war. After the war, the federal government decides they're going to set standards for certain industries in an attempt to avoid another calamity such as the economic downturn now referred to as the Great Depression. One of these regulations was housing and introduction of what is called the fixed rate mortgage. So what is a fixed rate mortgage? There is a lender, aka the bank, allows a home buyer, the borrower, to originate a loan. The home acts as collateral, and the interest rate on the mortgage remains fixed for the term or duration of the lending. The most common fixed rate mortgages last 15, 20, or 30 years. The purpose of the fixed rate mortgage is to allow the homeowner to budget, because the monthly mortgage payments and therefore the housing expense remains constant over the duration of the loan. So for instance, if a borrower initiates a loan, 15-year fixed rate mortgage, 180 equal payments made to the bank to pay for the home. Let's start at the top here and talk about some of the parameters that were in effect for a long time which ensured the system worked smoothly. First, there were strict borrower qualifications. Any individual household interested in purchasing a home using a mortgage financing needed to demonstrate a dependable, reliable source of income. We usually call that a job. The person had to have good credit, and it was also important to have some financial cushion, aka savings. It was nearly impossible to qualify for a loan for mortgage financing if the person didn't have verified income, good credit, and some savings. Anytime a person or household wanted to purchase a house, they had to use a 20% down payment. They had to make a 20% down payment on the home. Use some simple numbers here. I know this doesn't sound like a lot of money these days, 2023, but assume a home was selling for $50,000 in 1975. Any person or household interested in purchasing that home would need to have a $10,000 down payment. That's 20% of $50,000, and they could finance the remaining 80% of the home value. Why was this arrangement important? This idea of mutual incentives between the lender and the borrower. Any potential home buyer who saves 20% of the price of the house and puts that down as collateral against the loan now has incentive to continue to pay back the mortgage, or they would risk losing that money forever. Likewise, the bank was in a good position, because if a person made a 20% down payment and the bank only financed 80% of the home's value, if the person defaulted or the household defaulted on the loan, the bank would acquire the property and could easily sell it for more than what was left on the mortgage balance. So this idea of mutual incentives with the 20% down rule. Another key idea here is, we're going to talk about why and how this changed later. Banks held mortgages. In other words, if ABC Bank in town XYZ originated 10 mortgages for $40,000, the bank had $400,000 worth of loans on its books, and the bank serviced those mortgages. So there was this relationship between the borrower and the lender. As I said earlier, most fixed rate mortgages were 15, 20, 30-year duration. Actually, for quite some time, there was a 10-year mortgage, not quite as popular these days. On the next slide, we're going to demonstrate what is called the mortgage amortization schedule. The way a fixed rate mortgage works is as follows. The payment remains the same over the duration of the loan, as stated earlier. 15-year mortgage, 180 equal payments. 20-year mortgage, 240 equal payments. 30-year mortgage, 360 equal payments. But the amount of the money that's dedicated to interest versus how much is going to principal actually alters over the duration of the loan. In the beginning, most of the payment goes towards interest and only a little bit towards principal, and that relationship changes over the course of the loan. This is because the bank gets their money back first, the interest. We're going to use this example down bottom here to demonstrate these important points of fixed rate mortgage, fixed payments, and amortization schedule. So assume somebody purchased a home in 1998. The home price was $190,000. The individual put a down payment of $40,000 against the value of their home and therefore financed $150,000. So again, home price $190,000, down payment $40,000, mortgage $150,000. The mortgage interest rate, the interest rate on the mortgage, 7.875%. So for the next 30 years, this person will pay equal payments. The interest rate will remain the same, 7.875%, and each payment, each of the 360 payments will be exactly $1,087.60. Mortgage amortization, introduced on the previous slide. These numbers help visualize the importance of this economic concept. Remember, an individual purchased a home in February 1998. Home price $190,000. Down payment $40,000. Mortgage $150,000. The interest rate on the fixed rate mortgage 7.875%. 360 equal payments of $1,087.60. Notice in column 2 the payment is the same every month. Monthly payment $1,087.60. Look up top, it says mortgage balance, top right, $150,000. Before this person makes any payments, they still owe the entirety of the mortgage. Now the idea of mortgage amortization. Again, the payment will remain the same every month, but the amount of the payment dedicated to principal versus how much of the payment goes towards interest changes over the course of the loan. In the beginning of the loan, most of the payment is dedicated to interest with very little going to principal, and then this relationship changes over the duration of the financing or loan. First payment, only $103.22 goes to principal. The bulk of the payment, $984.38, goes to interest. And then notice every month this changes a little bit. So by the end of the year, the last payment for this year, December 1998, $978.12 goes to interest, $109.48 goes to principal. Important idea, fixed rate mortgage, the interest rate remains the same, 7.875% over the course of the loan. Payment remains the same, amortization schedule. Quick review of the traditional mortgage financing process prior to investigating the cause of the 2007 financial crisis. Discuss the relationship between the bank and the borrower. Under the traditional system, any individual interested in mortgage financing needed a 20% down payment. The example on the board here, if Sally or Sam purchasing a home for $50,000 needed $10,000, 20% of the home value down payment, could finance the remaining 80%. Why was this arrangement mutually beneficial for both participants? The individual purchasing the house using mortgage finance was incentivized to continue to make payments, otherwise they'd lose that big chunk of change they plopped down against the value of the house. Likewise, mortgage financing allowed individuals to buy a house which would be otherwise out of their financial means by paying for it over time. Banks were incentivized to seek out creditworthy borrowers, service mortgages, and collect interest. Along comes the government and introduced programs which would be one of the contributors to the 2007 financial crisis. The government was guilty of an economic fallacy known as causation versus correlation. The government observed data associated with homeowners, data including the level of educational achievement, occupational success, divorce rates, accumulation of financial and economic wealth, and there was this correlation. By and large, households who owned their house as opposed to rent it had much better financial and economic success. So the government believed there was some type of causation between owning a home and achieving this financial and economic success. The government introduced programs to lower middle-income Americans in an attempt to catapult these peoples into the same financial and economic situation. Renting isn't the worst thing. There are costs associated with home ownership that a renter does not incur, including property taxes, homeowners insurance, repairs, maintenance. People living at the margin aren't necessarily in a financial position to incur these expenses all the time, so renting isn't the worst possible financial decision. When the government introduced programs which opened the opportunity for low middle-income individuals to purchase homes, a new mortgage was introduced to the financial community, the subprime mortgage. The subprime mortgage pretty much is what it sounds like. It's a mortgage available to someone who does not have perfect credit, but banks aren't going to offer the same interest rate to individuals with less than credit-worthy credentials. Therefore, subprime mortgages had higher interest rates than traditional mortgages. Lending institutions exist to maximize profits by minimizing risk. When subprime mortgages were introduced to the financial community, banks reacted by creating what was now become known as the mortgage-backed security. Let's discuss how securitization works. ABC Bank originates 20 subprime loans, each value of $50,000. So 20 times 50, that's 1 million. If ABC Bank holds those loans, they're now holding the risk of default, not being repaid if the borrower fails to make the payments. The bank realizes they could package these mortgages together, take all 20 mortgages, $1 million worth of borrowing, create a mortgage-backed security, and sell these to individuals and institutions interested in purchasing them. Interest rates were extremely low during this time. Investors were looking for what's called yield, or a higher interest payment. So these mortgage-backed securities became attractive financial instruments in the investment community. However, this process ultimately introduced what has become known as the triple threat to banks. First, investment banks, Morgan Stanley, Bear Stearns, Lehman Brothers, purchased large amounts of these mortgage-backed securities. Then the banks who created the mortgages, but then sold the mortgages off as mortgage-backed securities, lent money to the very same institutions who purchased the mortgage-backed securities. I assume you can see the danger in this relationship. Further, the banks who created some of these subprime loans and therefore created the mortgage-backed securities held some of the mortgage-backed securities themselves and actually purchased some mortgage-backed securities in the open market as they were an instrument to meet capital requirements for the bank. Now, AIG was a big participant in the next idea here, collateralized debt obligations. First, what do we mean by a derivative instrument? A derivative instrument is a financial instrument which derives its value from another financial instrument. So, in an effort to reduce the risk of owning mortgage-backed securities, a collateralized debt obligation was introduced. Now, these become a bit complicated, but it's a complex structure of finance product that's backed by a pool of loans and other assets. In essence, it's an insurance against the default of the mortgage-backed securities. Now, of course, this is getting a bit complicated. If you're really interested, there's an excellent movie called The Big Short. But here's the key. Remember, the whole process of mortgage securitization and then collateralized debt obligations is all tied to, number one, the value of homes on the market, and number two, the continued repayment of loans by borrowers. It is important to revisit the relationship between banks and investment firms and describe what has become known as the circular firing squad. Let's review. Banks originated mortgages, banks packaged these mortgages together, and banks sold these mortgages to investment firms as financial instruments known as mortgage-backed securities. Bank, Wells Fargo, investment firm, Salomon Smith Barney, Bear Stearns, Morgan Stanley. So the banks create these mortgages, they package them together, sell them off as financial instruments to these investment firms. Then the banks lend money to the very same investment firms which have purchased the mortgage-backed securities. Now, companies like AIG underwrite insurance to these mortgage-backed securities using a derivative instrument known as a collateralized debt obligation. This, my friends, is what became known as the circular firing squad. In essence, it's a Ponzi scheme. Banks creating mortgages, packaging the mortgages together, selling the mortgages to the investment community, then lending money to the very same firms who purchased the mortgage-backed securities, and then having a derivative instrument which, in theory, underwrites or insures the repayment of the mortgages to begin with. Alan Greenspan was the head of the Federal Reserve, Fed chair at the time of the financial crisis. Not to say that the Fed was complicit with this arrangement, but Alan Greenspan did tout the value of the mortgage-backed security and other derivative instruments as a way for the financial community to diversify the risk of these subprime mortgages and new investment arrangement. What happens when a house is constructed without proper foundation? That's right, it collapses. In 2007, the fictitious growth in the housing market built by derivative instruments, mortgage-backed securities, and improper lending standards eventually led to the mortgage default crisis. Let's discuss those lax lending standards. Banks in the old model created mortgages, held mortgages, serviced mortgages. Banks were interested in verifying the creditworthiness of borrowers. Now that banks were simply creating mortgages, packaging them together, and selling them as mortgage-backed securities, they weren't altogether worried about the creditworthiness of borrowers. Likewise, borrowers were not mandated to prove income and were allowed to borrow large amounts of money against homes, values higher than they would have otherwise qualified for, leading to higher monthly mortgage payments. Two events happened simultaneously, which was the catalyst for catastrophe: falling home prices, rising interest rates. Many subprime borrowers did not engage in traditional 15, 20, 30-year fixed rate mortgages. Instead, they were placed into adjustable rate mortgages. You may have heard the term predatory lending. Some of these low to middle income individuals, first-time home buyers, may have been unaware that on an adjustable rate mortgage, the monthly payment actually adjusts, and it adjusts upwards when interest rates increase. This made the monthly mortgage payment more expensive, making it more challenging for many of these individuals to make the finance payment on their home. Many other individuals who had borrowed copious amounts of money against houses realized that they were underwater on their loan. What does this mean? Mortgage balance $300,000, new market value of home $200,000. Many Americans decided it's not worth it to continue to pay on a mortgage where the home price is worth far less than the mortgage balance, and they simply walked away from their mortgages, handing the keys back over to the bank. Mortgage defaults introduced insanity into the derivatives markets, specifically mortgage-backed securities and those credit default swaps, collateralized debt obligations discussed earlier. Let's review. Remember, banks were involved with the triple whammy issue. First, banks created subprime mortgages and sold them to investment firms. Banks turned around and sold many of these, banks turned around and lent money to the very same financial firms which had purchased the loans. We describe this idea of a circular firing squad. So Wells Fargo Bank creates mortgage-backed securities, sells those mortgage-backed securities to Morgan Stanley, and then lends money to Morgan Stanley. Obviously, this is a recipe for a disaster. Additionally, banks held some of the mortgage-backed securities they created, and to meet capital requirements, actually purchased some of them on open markets. When homeowners began to default, especially subprime borrowers, the value of these financial instruments, the mortgage-backed securities, whose value was derived from one, home prices, and two, the ability for borrowers to repay mortgages, all of a sudden mortgage-backed securities dropped dramatically, exponentially in value. Likewise, those collateralized debt obligations, which were in theory insurance against mortgage defaults, again, AIG, one of the companies that eventually needed to be bailed out by the government, huge originator of these basically worthless derivative instruments, the entire house of cards came crumbling down. Banks across the country are in serious trouble. Huge exposure to the subprime mortgage markets and derivative instruments associated with the housing industry. Likewise, investment firms, tremendous financial risk because they were too invested in the same derivative instruments. The financial crisis begins to threaten the economic well-being of companies that are completely unrelated to the financial industry. These unrelated victims depend on the lifeblood of the economy, lending, to function. The entire system was on the verge of collapse. Most businesses do not hold a ton of cash on their balance sheet. Cash offers no return. Businesses typically take cash and invest in capital, machines, equipment, tools, factory, that are related to their economic activity. Small, medium-sized firms depend on short-term lending facility to finance operations. ABC Corporation borrows $1 million per month, uses the $1 million to finance salaries, materials, utilities, and then easily pays back the loan at the end of the month through revenue generated from operations. Companies that are in business 20 or 30 years borrow every month, no problem paying it back, never missed a payment, all of a sudden have no access to the lending market because the financial system has locked up. Banks won't lend to other banks because banks do not know if their competitors will be in business tomorrow. Without the lifeblood of lending, there was a possibility the entire economic system could come to a screeching halt. We were on the verge of economic abyss. It was time for rescue operation led by the Federal Reserve. With the financial industry in absolute dire straits, something needed to be done, and something needed to be done rather quickly. The federal government responded with a program known as TARP, Troubled Asset Relief Program. So Troubled Asset Relief Program, it allocated $700 billion in emergency loans. Now, who was receiving the loans? The very same lending institutions and financial corporations who created the issue, the same problem. So that brings up a frustrating political point when you think about the federal government handing out nearly $1 trillion worth of emergency program funding to the banks and the financial institutions which caused the issue to begin with. However, the program made sense because what it did was it created a bridge. Imagine if you owed someone $5,000 in 1 month and you didn't have $5,000, but you knew that in 2 months you would be receiving $50,000. In essence, the banks and other financial institutions had functioning aspects of their business and knew eventually they would be profitable, but the liquidity crunch made it nearly impossible for them to fund debt obligations in the immediate future. So what the Troubled Asset Relief Program did, it provided that bridge of liquidity from today until tomorrow. The idea was pretty straightforward. The federal government, in the form of loans, purchased collateralized debt obligations, mortgage-backed securities, those very same derivative instruments that were the toxic financial fuel for the downfall, understanding that in reality, only a small percentage of that market, the mortgage-backed securities and the collateralized debt obligations, only a small percentage of them were dropping in value. The government banked that these assets were oversold, and by putting a floor in the market, by purchasing large quantities of them, their prices would stabilize. And the practice was perfect. Crazily enough, TARP ended up being the most profitable government program in the history of our federal government. It's insane to think about the whole entire events from start to finish, but the banks by and large paid back the loans. The government had bought large quantities of these troubled assets. Between the loan repayments with interest and the increase in the price of the assets purchased at rock bottom values, TARP ended up being a financial windfall in the long run for the government. But it introduced a problem called moral hazard. Lehman Brothers went bankrupt. Bear Stearns was rescued. Why? It was really just a matter of timing. Bear Stearns asked for assistance first. At the time, Federal Reserve didn't realize that the financial crisis was universal and not specific to one financial institution. The idea of moral hazard is straightforward. In a capitalist system, we don't want our Federal Reserve, our nation's central bank, or the federal government picking winners and losers when it comes to which businesses survive and which businesses fail. In addition to the federal government introducing the TARP program to offer $700 billion of liquidity in the form of loans to the banking system, our nation's central bank, the Federal Reserve, implemented unique and massive programs to intervene in the financial market to rescue the economy from catastrophic failure. The Fed has always played the role of a lender of last resort. The Fed lends money to banks and other financial institutions who are short on reserves or have liquidity issues, solvency issues at what's called the discount window, charging an interest rate called the discount rate. Prior to the great financial crisis, this was typically used very seldomly, as a bank or lending institution who visited the discount window was kind of looked upon as having some issues and a bit worrisome as far as their long-term solvency. Loans from the Federal Reserve in the form of the discount rate at the discount window were typically of around $150 million or less. $150 million sounds like a lot of money to you and me, but in the banking industry, it's not a big chunk of change. When the financial crisis hit, the Federal Reserve seriously extended and reinterpreted its role of lender of last resort, introducing all of these various programs. Additionally, the Fed became what is known as buyer of last resort. The Fed introduced 4 rounds of what's called quantitative easing, purchasing long-term government bonds and mortgage-backed securities in an effort to bring down long-term interest rates to encourage investment and spending. These quantitative easing practices investigated in more detail when monetary policy is covered. For now, when the 2007 financial crisis hit, what new programs did the Fed introduce? Primary dealer credit facility, the term securities lending facility, asset-backed commercial paper money market mutual fund liquidity facility, commercial paper funding facility. Geez, this is a mouthful, huh? Money market investor funding facility, term auction-backed security loan facility. Additionally, the Fed began to pay interest on reserves. Banks now found themselves with large amounts of reserves as the Fed purchased billions and billions of dollars worth of mortgage-backed securities from financial institutions. This changed the very nature of the central bank and how they conducted monetary policy. More about that later, but in a nutshell, central bank response to the financial crisis, massive is probably the best adjective to describe Federal Reserve actions. How did the system contribute to the housing crisis? Well, first we have these 2 institutions, Fannie Mae and Freddie Mac. So Fannie Mae and Freddie Mac, they were created by Congress, and they perform an important role in the nation's housing finance system, and that is to provide liquidity, stability, and affordability to the mortgage market. Now, these are, as best described, quasi-private, quasi-public institutions. So how did they contribute to the housing crisis and the 2007 financial mortgage default crisis which ensued? Well, the interesting aspect of these 2 institutions is that in many ways taxpayers bore the risk of the loans held by Fannie Mae and Freddie Mac. At the same time, the banks kept the profits of these transactions. The remainder of this slide is simply a list of government programs which contributed in some way to government institutions, Fannie Mae and Freddie Mac, playing a much larger role in the mortgage industry than prior to the crisis. This graph chart here shows from 1991 through the time period leading up to the crisis how much Fannie Mae and Freddie Mac grew as far as what percentage of the mortgage market they controlled. And you can see it went from 1/4 of the mortgage market to nearly 1/2 in that 14-year span. One approach to analyzing the potential crisis of the mortgage industry is by determining what percentage of total mortgages could be labeled as risky. On the far left here in our chart, we have total value of U.S. mortgages in 2001, and then what percentage of those mortgages would be characterized as risky. So in 2001, the total mortgage debt financing of all U.S. households just above 1.4, we'll call it $1.48 trillion, and a fraction, and we would say an acceptable percentage of that debt labeled risky. Notice in 5 years, not only had the absolute value of mortgage debt increased significantly and substantially, the percentage that was labeled as risky grew to an alarming rate. So total mortgage debt increased from 1.47 trillion all the way up towards $2 trillion. So a near 33% increase in mortgage debt in just 5 years, with a more than tripling, quadrupling of the amount of the mortgage market which could be labeled risky. After the financial crisis became apparent to everyone and the mortgage default crisis began to wreak havoc in the economy, it was obvious that lending standards had to be resumed. Notice by 2008, many of these risky mortgages no longer represented high percentage of the total mortgage market, and total loan debt declined significantly, mostly because of the multitude of foreclosures. When the dust settled, what transpired? In response to the 2007 mortgage default crisis and the economic downturn which ensued, the federal government responded with the most far-reaching Wall Street reform in history, affectionately known as Dodd-Frank, officially known as the Wall Street Reform and Consumer Protection Act. The idea behind Dodd-Frank is to prevent excessive risk-taking that led to the financial crisis. And the law also provides common sense protections for American families in an effort to create new consumer watchdog to prevent mortgage companies and payday lenders from exploiting consumers. Like all government regulations, there are pros and cons, and there is a normative debate about the effectiveness of Dodd-Frank. Yes, intention was good. Reality may be another observation. Critics of Dodd-Frank point to the fact that it is cumbersome when it comes to regulatory issues and the idea of qualifying for lending. It makes it far more challenging with anyone with not perfect credit to qualify for a loan, therefore making it more difficult for low and middle income households to purchase a home. Even for individuals with excellent credit, it's a lot more challenging as far as the hula hoops that one needs to go through to execute mortgage financing.